Good morning, everybody. And if you can tell from the sound of my voice, I'm been trying to outrun a head cold and I'm losing the race, so please be tolerant. My name is John Dieker, Vice President Strategic Projects for Bombardier Learjet. And what I'd like to do this morning is, first of all, take a little time and give you a little background on Bombardier and Bombardier Inc. Then a short look at the current market conditions, market drivers and market influencers. Then we'll take a look at the business aircraft market forecast and follow that with the look at the commercial side. When Jeremy first called here a few months and asked me if I would speak today, after the panic set in when I said yes, and then I started to think about what we were going to say, I went on an exhaustive search trying to find the software or the mechanism to answer the questions we kind of all want answered. And I did come up with something I want to share with you that provisionally provided an answer to all my questions. And if you notice, I got it in a little black and gold bag here. And it does provide an answer to every question that we've ever had. And so when I ask you, when is the recession for our industry going to end, I got not sure. So if you think about what we've been through in the past, when the industry first focused on that, it is a difficult question to answer, and we'll look at some of those influences and where we're going. So I'll take just a second and talk about Bombardier as a whole. Bombardier Inc. is headquartered in Montreal, Canada. Its revenues generate about $18.3 billion a year, and we have a workforce globally of about 70,000. 70,000. It's a big company. We're split into two different business avenues, aerospace and transportation. In aerospace, we're the #3 manufacturer in the world. We generate about $8.6 billion in revenue, and we have slightly more than 33,500 employees globally in our aerospace companies. On the transportation side, we're the #1 manufacturer in the world, with revenues of just under $10 billion and a workforce of over 36,000. Very proud to be a part of that company. Within the aerospace side, we have 5 major business units. The business jets, which comprise Bombardier Learjet, the Challengers, and the Globals. The commercial side with our CRJ series, the Q series, and the new entry into single-aisle market, the C series 1000 and 300. And then amphibious and special mission aircraft. On top of that, we have customer service opportunities, service centers around the globe, and we do have our FlexJet, which is our market share company for FlexShare. When this commitment the company has, I want to talk philosophically about where we're going and what we're doing. Over the last 10 years, if you remember back into 2003, 4, 5, 6, even into the start of 2008, business for our industry was really good. There's not a lot of investment went into product development. But since 2008, the world has changed, and the company has philosophically dedicated itself to product enhancement, product improvement. We're working diligently, investing billions of dollars to be sure that when the recession does recover for our industry, we're there with the right product at the right place at the right time. That commitment resulted from the company started in the aerospace industry in 1986 when it bought Canada Air. We've since introduced 25 different platforms across the 25 years. It's been a commitment, long-term philosophy to keep the innovative products in front of the customers perpetually. But when the tough got going, the company stepped up and said, we're going to make sure we're ready when the time comes. Very proud of that. Today's portfolio of products on the aerospace side revolves around the Learjet family, which we have the 4045 that's transitioning to the 7075, the Lear 60XR, and the brand new Learjet 85. On the Challenger family, that's our mid-range and mid-cost product, runs $20 to $30 million in price in the global family. On the commercial side, we have the turboprops, the Q series, the regional jets, the CRJ Next Gen, and on this new entry into the market, our single-aisle mainline jets, the C Series 100 and the C Series 300. Well, why are we excited about this? Well, the short run is pretty tough. The short run is really still tough. But if you look at where the business aircraft fleet is, over the next 20 years, our economists, and we have some smart people at Bombardier that work on these things that help us make right decisions, our economists believe that there are some 26,000 aircraft delivery opportunities across the industry on the business aircraft side. That's $626 billion of revenue opportunity over the next 2 decades. On the commercial side, the story's almost the same. The opportunities for deliveries are 12,800 units, over $610 billion in revenue. And part of that's driven based off of fleet retirements. So you see a net growth across business aircraft and commercial of a substantial margin, going from 14,200 units in 2010 upwards of 29,000 units in 2029. On the commercial, it's the same way, from 11,200 units upwards of 17,300 in 2029. The other piece of the business that we operate in is the MRO business, providing maintenance, service, and repair for our products. And from a revenue improvement point of view, we're looking at increases of $4.5 billion upwards to 7.8 across the 10-year period. So let's spend a few moments and talk, if you will, about the current market, such that it is. If you look at the current market for business aircraft, we divide it into 3 major sectors: light, medium, and large. The light categories are most of us here in the community do business. It's the aircraft price range that is less than $20 million. The medium category is 20 to 40, and the large category is airplanes that retail for $40 to $60 million. But what I want you to notice is in 2008, we had over 900 deliveries across the industry. In 2009, that was 574, 544 in 2010, and then 563 or thereabouts in 2011. But if you look at 11 over 12, there is some slight encouragement. Q1 and Q2, 11 versus 12, we've seen some slight increase in over year. The concern, though, is the numbers aren't anywhere approaching what they were previously in 2008. And if you look at the bars on your right, you'll notice that the red colors are significantly impacted more than the blue and the gold. The gold being the large airplanes, the Gulfstreams, the Globals, et cetera. That market's been almost immune. The mid-range product market has done a reasonably good job of sustaining itself, but the light market that most of us and our competitors here locally do business in has really struggled. And that struggle continues today. One of the indicators we look at, and we look at several, and we'll talk about those as we go forward, is the amount of used aircraft inventory on the market. I'll tell you a little story in 08-09 when the cancellations were way outrunning orders. If you looked at, I remember looking at the used aircraft inventory media for what airplanes are for sale and how much they run, and you actually seen airplanes listed for sale that hadn't been delivered yet, which means that the customer was going to take the airplane, had already listed it for sale because either couldn't afford it or didn't want it, and the cost of cancellation is not what they wanted. What that put on the market was a glut of new used or very slightly used airplanes. That really restricts the demand for new, and it impacts the price very dramatically, neither of which are good for our industry. But today, those normals are getting much more towards historical averages, which is good. We'd like to see them come down another percentage point or two, but at 8.7% for the models in current production, which is the lower line, all aircraft, used sales across all aircraft is the upper line. If that gets down around 12 and 7.5, then that would be much more normal for what we're used to, and that will drive demand, which is one of the good things we're looking for. Another indice we look at is aircraft jet utilization. And I have 2 charts up here. The one on the left is the U.S. business jet utilization percentages, and the one on the right is European. If you look at the U.S., we've been on a gradual improvement trend since 09, which is good. It's kind of got flat in the last year or so, but it really hasn't deteriorated much. I know the chart says -1%, but that could be in the noise level. In the Europe, it's much more cyclical with the spikes coming in Q1 and Q4 for the lower usages. This utilization record also gives us some positive that people are starting to believe that the economies are going better. But is it a long-term indicator? Yes, it is, but it still needs to get better and go forward. There are some mixed signals coming, though, out of the UBS Business Jet Index. The last 3 quarters have shown a substantial drop in customer confidence. When pressed about what that meant, it is the fact that 2 of the survey questions in the survey asked, are you ready to make a purchase this year, and how willing are you to do that? And the answer was not very positive, and most of us in this industry locally can understand that request. They did, though, justify that and say, we believe that's going to change. We believe that the market is improving, and we think we'll see a 4th quarter bump. So we'll wait and see if they're right, because we need those things to go forward. On the commercial side, we see a demand for air travel reflected in orders. And if you look at the chart, you see a very cyclical industry, and when the GDP is getting better, orders go up. The spike at the end of the chart is the '08 degradation, and then right back up to 2011. In 2011, there were some 2,300 orders more than there was in '09, a 314% increase in orders for commercial aircraft. They've almost been immune. And if you listen to the numbers from Spirit, they've survived this recession very well, and my hat's off to those guys. They do a great job. If we look at some of the key market drivers, there are several things that continue to influence where we're going. And I'm not going to go through all these, but economic growth is a big factor. Air travel demand is somewhat cyclical, as we've seen, based on GDP. And the global GDP forecast at 3.2% is a positive indicator that that's going to continue to grow. Fuel prices and fuel volatility send mixed signals. We're seeing my friends up here earlier talking about fuel prices, and we'll look at that here shortly. But fuel prices are a concern when 34% of the operating costs of an airline is fuel. 34%, that's a huge number when you can't predict your price month over month or even year over year. It's a big impact on demand. But what it does for the industry is it makes the need to upgrade your products so you have more efficient assets that operate more effectively. And you'll see that demand reflected as we go forward, because there are going to be a lot of retirements of these older airplanes that are going to drive demand going forward, which is part of what the replacement demand is all about. Emerging markets, we've heard our associates talk about China and India and Brazil. We see the same thing. The infrastructure's not there, but that's a coming market, and we'll talk about those markets as we go forward. And other influences of environmental, just to note that if you remember, as a young man, I used to play in the yard, and we'd have airplanes coming over McConnell, and they would rattle the windows. I mean, just run you out of the yard. You don't hear that today. The dB market's down substantially. They're some 35 to 40 dBs quieter than they were even, back in those days. And I hate to say 40 years ago, but that's what it was, 40 years ago. Another thing you may find interesting, that if you use a fuel burn ratio of 3.5 liters to 100 passenger kilometers, that's equal to about what we have in a hybrid car driving around on our city streets today. So it's a very new aircraft technology. It's very effective and very efficient when it comes to managing fuel. The new technology going forward is important to the industry. Through an ICAO-led council, we've committed to improve our carbon CO2 emissions by 50% by the year 2050, which means technology is going to continue to go forward. And the new technology is going to drive demand because of the inability to take the fuel prices and run the old airplanes. That maintenance cost and those operating costs are going to be a major factor in replacement demand for the commercial airplanes. One of the issues that we look at is fuel cost and fuel volatility. And this chart that I just now throw up here gives you a change in forecast year over year from 2011 to 2012. And it's showing that the forecasted price per barrel of $126 per barrel for oil across the 20-year period is an extreme level of volatility for the market, and it continues to grow. It's one of the issues that the industry is working on to make sure we put assets out there for our using public to ensure that they have the most effective means of managing that cost, which is the biggest piece of their operating revenue. We'll pause for a minute and look at the business aircraft market. We're going to talk about the next two decades or thereabouts. We're starting with the year 2000 and look at compare it to 2010. And what you see is a ratio of business aircraft to $100 billion of GDP based on U.S. dollars. And you see there on the far right that North America is the biggest demand and the biggest spot for our airplanes. But you see some real growth in the Russia and CIS industries. The last 10 years, they have a market increase in their fleet distribution, which is a good thing. It tells us that the market is changing. The market is changing. It also gives you some confidence that with GDP forecast to improve in the emerging markets, that's where our market's going to be going forward. Not that the U.S. market's going to deteriorate, but it's going to be less rapid than the rest of the world. So if you take those GDP forecasts and blow it forward, what you see on this chart is basically that same forecast that says overall the industry is going to grow. You see the North America, which is the black line on top, at a very flat, growth rate with a lot of curve. But the red one at the bottom shows a tremendous uptick in Asia-Pacific time frame. That's where a lot of us are involved, China, Asia-Pacific, trying to enhance that market over there, even though the infrastructure to support the asset doesn't exist there yet. But it's coming. It's coming. So what does this mean for BA? If you take across the three sectors, light, medium, and large, you see a tremendous opportunity. The column on the left gives you revenue dollars with some $292 billion in opportunities over the next 20 years. If you combine the units all together, we believe from our economist projections, there's some 24,000 units of delivery opportunities available in the next 20 years. Across the revenue, the light sector that we mostly do business here in Wichita doesn't generate the most revenue, but it does generate the most units. You get an increase of 10,700 units in the light category over where we're at today. So there's lots of opportunity for growth in that market also. If you push it to the world, it kind of looks like this, with the North America market showing still being the largest market. The darker blue inner circle is the first decade, and then you lay over the top of that the second decade in the lighter blue circle. You see how big it gets 20 years from now. But you'll also notice the growth in the European continent, in China and India. And if you look at India, which is kind of center bottom, you'll see that the dark blue dot in the first 10 years is much smaller than the lighter blue. That growth is expected to happen over the next 10 years following our current decade. But the numbers of 24,000 units are especially enticing, especially if you think about even if we're off 20%, it's still big numbers. It's still big numbers. As I said earlier, if you look at the transitions of the fleet, you notice that the North American continent still leads the fleet in percentage of worldwide fleet, but it's changed from 64% to 44%, which means the rest of the world is growing faster than we are. You'll see China make a huge jump from where it is today, where it is going forward. So the traditional markets that we have enjoyed are all changing, and it's becoming a much more global marketplace. There are some drivers in the commercial market that we need to be aware of too, and I'll spend just a few minutes and discuss those. One of the things that drives demand is passengers in seats, passenger seat miles. Part of that is, most of that's driven by middle-class spending, consumer spending. And if you look at where consumer spending was in 2009 at $21.3 trillion, not billion, trillion dollars, and that's expected in 2030 to go to 55.7. That says that the GDP across the emerging countries is really, really going to change. In the Asia-Pacific middle-class spending is forecasted to jump 32.6 trillion by 2030 compared to what it was at 5 trillion in 2009. 6 times. 6 times. In South America and Africa and Middle East, middle-class spending is poised to double. With that kind of spending opportunity, travel, tourists, all those issues come to drive demand for new products. And with that kind of spending, if the GDP forecasts are right, that kind of spending is real, the demand will be there. The demand's also going to change the mix of the fleet. We talked about fuel prices here just a while back. And if you remember 10 years ago, nobody wanted to ride on a turboprop. But with the efficiencies of that technology, turboprops are going to keep a spot in the industry today. For shorter hauls in emerging country, there's a big market for turboprops going forward. So don't give up on the turboprops, and you may want to think about, whether or not you want to ride them or not, because they're very safe, safer than the others mechanisms do that. Those turboprop efficiencies far outweigh the operational costs of old jets. The technology is also going to drive increased aircraft retirements, which means that the old technology is going to go away and give way to the new stuff. If you look at the fleet evolution from 2011 to 2001, in that smaller seat environment, you're going to see a substantial change, and a big piece of those is in replacement at some 7,000 units. Natural growth from 11,200 units to 12,008, but at least half of that 12,000 is replacement opportunities. That age is going to increase as the retirements increase, as the age of the airplane gets older and older, with about 60% of the current 20 to 149 seat market being retired. The new generation airplanes from 100 to 149 seats was where we expect most of the growth to continue and the replacement to happen. We expect that 70% of the current fleet retirements will be in the 20 to 59 seat segment. So it looks like this. If you divide the commercial segment up into seat markets, in the 20 to 59 seat market, which is the section on the left, you'll see almost no growth in all retirements. The dark blue at the ends that shows that unit's degrading over the next number of years. But the next three, the 60 to 99 seat and the 100 to 149 seat, show substantial growth. And then if you total it all together, you again see growth from 11,200 units to 17,000, with about half of it being in replacements, with new technology replacing old technology. And the demand is shifting. If you look at the demand across the world and look at GDP, you notice that in North America, we're still the largest demand, but the rest of the world has caught up to us. And that was shown in the bar chart we showed, where the demand went from 64% to 44%. Still the biggest market, but our market locally is not increasing. So it means our focus has to go globally in order to participate in the growth and go forward. So in conclusion, I'd like to let you know that we're bullish about the future. We're concerned about the immediate future. When I looked at my little black ball here and talked about what's going to happen next, I get the same answers to every question I ask, not sure. In 2008, we thought this would end in 2010, and 10 we thought it was going to be 11, and 11 we thought it was going to be 12. And we're still not quite there yet. We have a lot of work to do, but ladies and gentlemen, the long-term future for this industry is strong, and we are glad to be a part of that and glad to be here in the city of Wichita. Thank you very much.